Welcome back to another episode. Today we're going to be talking about Walt Disney, their recent earnings, and what investors can expect in the future. So Walt Disney reported earnings yesterday on the 13th. And they had this revenue miss of around 1.29% from what analysts were reporting. The reported revenue was $22.46 billion, and the estimate was $22.76 billion. So not that big of a miss. See that the stock price went down and investors reacted pretty poorly to this earnings miss. Now their earnings per share was positive, reported 1.11 and their estimate was 1.045, 6.19% surprise from what analysts were estimating. As we start to dive deeper, Walt Disney is starting to show some signs of weakening. So obviously, Walt Disney owns their own TV channel, their own film production, and their amusement parks and theme parks. They also have cruises. That's a very popular attraction. Now, Walt Disney's media and entertainment distribution actually does very well for the company. This is things like Disney Plus, ESPN Plus, Disney Consumer Products, and Interactive Media. Now, this is a monthly subscription, very dependable source of income for Walt Disney. Not to mention, Walt Disney also owns ABC Entertainment, ABC News, a lot of these other California news stations, and then as well as owning ESPN. So Walt Disney has this huge list of assets. Their services take up around 90% of their total revenue. This is things like their theme parks, their cruises, their streaming services, and their news networks, as well as their filming production. And then their product takes up around 10% of total revenue. This is things like their actual merchandise they sell. Now, really what investors were reacting off of this lackluster quarter in revenue. You can see that in quarter 4 of 2025, year over year, they saw a negative 0.50% decrease. Now, it's also important to note that their earnings per share wasn't that strong for quarter 4 of 2025, but we can see here on a historical pattern that they don't have the best earnings per share for that quarter 4 result. Now, on an annual basis, their gross margin looks great, around that 64% average. We can see that net income year over year has grown very well. In 2021, it was sitting at $2 billion, and in 2025, it now sits at $13 billion. As well as their total revenue. In 2021, it was sitting at $67 billion. In 2025, they've grown it all the way to $94 billion. Disney has done a great job at slowly building up their revenue more and more through all of their products and services. And in 2025, they sit at a pretty even number of around 90% of their services for total revenue, and then their products around 10%. Earnings per share has grown great too, 1.09 in 2021, and now in 2025, 6.88. Very large leap there from 2024 to 2025. Now, this decrease in revenue can really be attributed to Disney's entertainment unit falling 6% from last year, primarily dragged down by the linear TV networks and theoretical releases. Disney's TV networks, including ESPN, have been unavailable for customers of Google's YouTube TV, a streaming provider of the pay TV bundle since October 31. Huge provider for Disney in terms of their ESPN TV network, and they've had this struggle with providing customers with ESPN. Now, there's no doubt that if you invest in Disney right now, you're getting it at a discount with the drop in price due to that revenue miss. Their price-to-book ratio right now is sitting at 1.92. Now, this has been growing from 2020 to 2024. If you're a value investor, you don't want to see this number grow. Although the S&P 500 average price-to-book ratio is 3.81. Now, that ratio is certainly undervalued, as well as the price-to-earnings ratio. Currently, it's at 18.29, and the average S&P 500 PE is 37.71. Another undervalued ratio. We can also see that their enterprise value has been growing. All the way from 2011, it was sitting at $70.72 billion. Now currently, it sits at $233.94 billion. Now revenue per share has been growing. Currently, it's at 52.15, as well as their free cash flow per share, which has grown to 6.40. Now their free cash flow also has been growing. Currently, it's at $11.55 billion, and all the way back in 2011, it was sitting at $3.44 billion. And the chief finance officer for Disney stated that they're going to be doing a huge stock repurchase program as well as strengthening their dividend. So they're giving back this free cash flow to investors. So all of this is good. Their per share metrics look super good. Their price to earnings and their price to book are undervalued compared to the broader market. But really, what's most important right now is to see how they're going to grow in the future. Now, Disney did announce that ESPN is launching this new direct-to-consumer service in August of 2025. So you'll have access to all of ESPN's linear networks. That's ESPN, ESPN2, ESPNU, a bunch of other ones, as well as 47,000 live events a year. Disney also just announced this Toy Story 5 coming out. And the teaser trailer finds Woody and Buzz fearing technology takes over. But really, all of this is, future growth for Disney. They need to continue to push out new products and new services, as well as strengthening their current products and services, and creating new TV series and shows such as Toy Story 5. Now, if we look at the numbers in terms of growth, revenue growth forward is sitting at 4.18%, and the sector median is 3.37%. They're outbeating the sector, and that 4 to 5% for a mature company is super suitable and a great growth prospect. Their earnings per share diluted growth forward is 19.93%, again outbeating the sector, which sits at 11.48%, and their free cash flow per share growth rate forward is 24.68%, outbeating the sector. So overall, I think Disney is definitely warranted as a buy right now in terms of long-term investments. They're undervalued in their ratios. The future growth looks great. They're expanding their businesses through ESPN as an example, as well as creating new shows and movies such as the Toy Story 5 coming out, which should boost sales incredibly. And their growth numbers look great. Now, a really positive thing about Disney is that you're not just buying it for that growth in price, which will definitely happen over the long run, I believe, but they just announced that they're going to strengthen their dividend. From 2021 to 2023, they had $0 in dividends, and now in 2024 is around 75 cents per share. But we can see at the height, they had a dividend of 1.76. The CFO just announced they're going to strengthen the dividend, and we could see numbers of 1.76, which makes this an incredible dividend stock. From the financial statements, they're definitely showing some signs of weakening. They really need to rebalance things, and I think a lot of companies, as they're starting to release their quarter 3 2025 results, we can see that there's a lot of signs of weakening within many industries. Buying it right now, you're getting it at a discount. I think over the long run, it will certainly pay out. Now, I figured I'll just kind of update you guys on my current portfolios. So the Deep Value Fund has not changed. I'm still holding Bowhead Specialty Holdings, which is starting to actually regrow. Now, in terms of the Summit Growth Fund, this has probably been one of the best portfolios in terms of performance. You can see that it's considerably outbeating the S&P 500. Right now, my portfolio sits at 22.36%. And I actually just added Walmart, which I made a video on, which I definitely think you should check out. And then my Haven Fund has not changed, still holding some of those broader ETFs. If you haven't already, definitely make sure to go join my Discord. The link's down in the description. It's completely free, offers a lot of good tools, and I'm really trying to build up a community. So as always, thank you guys so much for watching. Please leave your opinions down below on where you think Walt Disney will sit in the future. Make sure to subscribe, like, and comment.